Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is John Davey, founder and CEO of Astoria Portfolio Advisors. We're talking about Astoria's 10 ETF picks for 2024. And Astoria is an investment management firm that specializes in ETF managed portfolios, and they have been publishing this report for over a decade. John, welcome back. Happy New Year.
Happy New Year. Thanks for having me back.
So let's start with your market outlook for 2024. And we all know 2023 was all about the Magnificent Seven stocks, and we saw some broadening of the rally in December, and then 2024 started on a rather rough note the first week, but this week again we saw the tech giants outperforming. Now, I looked at your notes. So your notes suggest that investors should move out of cash. Now, you recommend increasing the equity exposure and equity beta. So tell us why you are positive on stocks in 2024, and what are the biggest risks to that positive outlook that investors should keep in mind?
Sure. So I would say that if you think about the last 1 to 2 years, investors have had to deal with a cycle which was consistent on rampant inflation fears, a very aggressive Fed that was hiking rates, low to negative real rates. We've had a bear market in technology stocks, and 2 years ago, cryptocurrencies, long duration bonds last year. Think about corporates, right? They've had to prepare for this pending recession last year, which never materialized. We had a U.S. earnings recession. So it was very much like one strategy last year, which is like T-bill and chill, right? A very complacent, kind of approach to portfolio construction. So our view is that, with the Fed's pivot in November of last year, is that, 2024 and beyond, and my 10 ETF ideas are really for like the next 12 to 18 months, is that, we're going to have a new cycle, right? So now what's changed? We now have potential Fed rate cuts. We have positive and higher real rates. We have inflation that has moderated. Yes, it's still above the Fed's target, but it's obviously come down a lot. We've had, lower interest rates, so that's helped alleviating some funding pressures. And that's why I think you see small cap stocks, doing better. So I just think your portfolio needs to evolve in 2024 and 2025. So no more T-bill and chill. So let's get out of, cash and let's go into bonds. Let's go into corporate credit. You don't need to own tickers like just, SPY and Qual. Like you can own other factors, you can own other sectors, you can own, the rest of the market, you can own small caps, you can own mid caps, you can own international. So that's a general thesis of the 10 ETFs report for 2024.
So you mentioned T-bill and chill. So we know that investors piled into cash and cash-like instruments last year, and there is about $6 trillion sitting in cash and cash-like instruments. Currently, over $1 trillion went into money market funds last year. Do you think some of that will come out of cash and get invested in stocks this year?
Well, some of that has definitely happened in the month of December. If you think about, SPY, I think they took in 50 billion of inflows, right. Last year, and a lot of that did come in, in December. Look, I think interest rates have to come down. I think like Fed funds probably below 3.5, around 3.25, probably gets some people. But if it's anywhere near 4 or 5%, people are going to still keep their money in money markets. I think that like our biggest impediment last year was always the T-bill. that's starting to like, because here's the thing, right? You have tremendous opportunity cost by just locking your money in T-bill for an entire year. You've been able to get, just in the month of November, corporate credit was up 7%. Like you've got years of, returns that you can potentially lose out if you just do T-bill and chill or money markets.
Right. So now let's talk about your portfolio for 2024. So what are the major themes of this portfolio? How did you structure the ETF portfolio for this year?
Okay, so one of our opinions that we've had for a few years now is that inflation, would be higher and sticky for longer. I've been on your podcast before, and we're the sub-advisor for the PPI ETF, which is the Access Historian Inflation Sensitive ETF. So we're very biased. We've always managed our inflation risk since the firm started in 2017. We've always owned real assets, gold, just because, whether inflation's 2 or 4, that can accumulate over time. So that's certainly part of the reason why we have, tickers like, the equally weighted industrial ETF, the equally weighted energy ETF. Those sectors are very cheap relative to the market. They've been ignored for 10 years. So we quite like equally weighted sector strategies in the inflation area. So that's the rationale for that. I think, markets equally weight S&P has been around since 1999. If any investors want to look at our website, historiadvisors.com, we have a chart that shows you the equally weighted index versus the S&P market cap weighted index. There's dramatic outperformance of equally weight over the market cap weight in the S&P 500 space. Past performance on indicative future results. It's not like a small amount. Why does that happen? You capture the value effect, the smaller cap effect. So we do like, equally weighted strategies in general. I think that the Magnificent Seven, they are certainly very interesting growth stories, but they're not the only ones out there. So I think that we have to think about other ways to kind of get broad-based U.S. equity exposure. We're trying to barbell our portfolio. So we as a firm always lean on quality as a factor. We've been proponents of, the DGRW, the qual, we own both of those ETFs in our strategies. But, we do think that you need to look beyond the US and look at some of these developed, international countries, in particular, Japan and developed Europe. We also have emerging markets in our portfolio. Again, just the idea that like any recession here in the US will be moderate. The rest of the world is cheaper. Frankly, the rest of the U.S. market is cheaper once you get past those 7 stocks. So we're trying to balance out our risk by owning, other sectors and countries and regions. I think extended duration is important. So we have corporate credit in our list. I would say even if I take a step back, last year we had the most fixed income ETFs in our portfolio. This year, we only have 1 ticker. So we're much more optimistic in general about stocks relative to bonds, this year compared to prior years. So we have some real asset strategies in our list. I think it's very important to kind of diversify your factor exposure. So we have like the SPGP, which is the growth at a reasonable price ETF. We're not saying to avoid growth. We're just saying to like minimize your exposure to just those big communication technology stocks. So tickers like QQQE is in our list. We like that. It's a NASDAQ 100. It's equally weighted, and then we have the RSPT in the list as well, which is the equally weighted technology ETF, RSPT.
So RSP is definitely a very interesting ETF, and this is in fact the first smart beta ETF. So the ETF celebrated its 20th anniversary last year, and as you mentioned, it has significantly outperformed the market cap weighted S&P 500 index since its inception in 2003. But when I look at the performance, the longer term performance, I noticed that most of that outperformance came in the first 10 years of its inception. If I look at last 10 years, last 5 years, the market cap weighted index continues to outperform. And last year, the S&P 500, the market cap weighted index, it outperformed the equal weighted index by its widest margin since 1998. That is according to a Wall Street Journal report. But yes, these companies did very well last year. So obviously, even though we see a lot of comparison to the tech bubble at times, I feel that comparison is not fair because these, unlike during the tech bubble, these companies are highly profitable and the valuations, though elevated, are comparable to those seen in recent history, and they have stable cash flows, low leverage. They can continue to do well even if the economy slows down. And you mentioned a tilt toward quality factors, qual, DGRW, both these ETFs. If I look at the top holdings, these magnificent 7 stocks are among the top holdings in all the quality ETFs as well. So these are high quality companies. So when I look at the portfolio, your portfolio, your 10 ETFs, I see a lot of equally weighted ETFs. So why do you think 2024 is the year when equally weighted ETFs will outperform the market cap weighted ones?
If you look historically, equally weighted strategies have outperformed their market cap benchmarks during periods of economic expansions. So the general rule of thumb is, okay, market cap outperforms going into the recession, equally weight outperforms once you get out of the recession. Given that, markets trend over time, they go up over time, it would make sense that equally weighted outperforms market cap. Our firm launched ROE, which is an equally weighted high quality ETF, ticker ROE. I would say that part of the reason why we launched it is because, we were uncomfortable with the mega cap exposures we were getting in those few select stocks. If you look historically at the top stocks in the S&P 500 index, they change over time, right? They don't stay at the top forever. I've seen periods where, General Electric is one of the biggest companies in the world, right? Now it's nowhere near that. I've seen periods where Exxon Mobil is, one of the biggest companies in the world. Now it's not a top 10 stock. So things change, things evolve. We are using ROE. Again, it's an equal weighted 100 stock high quality portfolio as a complement to our DGRW, our qual. We also use RSP in some of our strategies too. So it's just, how do you mitigate, your portfolio risk? If you think about Apple, for instance, right, they haven't grown their sales in 4 quarters, right? In our December monthly commentary, we put out a chart that showed the S&P 900 index and the stocks that make up that index, and we showed which stocks had 25% earnings growth over the last 1 year, or which ones had greater than 25% earnings growth, I should say. And only 2 of the magnificent 7 stocks actually had more than 25% earnings growth. NVIDIA was 28th on the list, so meaning that 27 other stocks had more growth than NVIDIA. And then Amazon was 86th on the list, meaning that there were 85 other companies that had more growth than Magnificent Seven. So this is a chart and analysis that one of our peers did. So I want to give them full credit for that. The point is that there's not just 7 growth stocks in the world. Those are fantastic companies, but it's reflected in the price. So, there's other growth companies. That's why we like QQQE. That's why we like RSPT, because they can give you that exposure to growth sectors and growth and the technology sectors, but have an outsized exposure from a market cap standpoint and a weighting standpoint. So that's part of the reason why we think, equally weighted, does have a place in a portfolio, particularly once you get out of the recession.
All good points. And in fact, I added QQQE to the ETF investor portfolio that I manage late last year. In December, I added that ETF, and my reasoning was the same because I believe that AI adoption and spending, they are expected to expand this year. So that will open up new avenues for business growth for more technology companies beyond the Magnificent Seven. And most investors already have a lot of exposure to the Magnificent Seven, either in the S&P 500 ETF or their QQQ ETF. So owning those stocks is fine, but adding some more equal weighted exposure would help a portfolio diversify a little bit away from these giants. So now let's talk about some of the important themes in your model portfolio for 2024. You mentioned overweighting cyclical equities, and the ETFs that you selected over there is the Industrials ETF and Energy ETF, RSPN and RSPG. Tell us a little bit about these two ETFs, why you decided to select these ETFs. Energy was one of the worst performing sectors last year, and it continues to underperform this year as well. But obviously, those energy stocks and ETFs look quite attractive in terms of value now. So tell us a little bit more about selection of these ETFs.
Okay, sure. So, and again, our big theme that we've had for a few years now is that, inflation would be higher, sticky for longer. There's like very big trends out there, deglobalization, onshoring, reshoring. So if you have that view that, we're going to be living in a structurally higher inflation world because more goods and services are going to be produced here in the US compared to, let's say, in Asia, that would be inflationary. And then, the industrial sector, let's say, would stand to benefit, along with the material sector and the energy sector. I do think that these are value, factors and value sectors that are much cheaper than the market. So that was the big rationale for why we wanted to use that. You can have, you can look at like XLB, XLI, XLE, which is the market cap weighted, but you get such outsized exposure in a few select stocks when you use those sector ETFs. So it just made a lot of sense for us to kind of choose the equally weighted versions of it. And the rationale for why we're saying those are cyclical growth, outside of them being the inflation plays, as the economy reaccelerates, like you want to own more cyclically oriented sectors, right? So if you think about last year, it was more so about qual, more so about S&P, which are like defensive quality kind of factors. S&P is, essentially, an actively managed index. You have to have 4 quarters of net positive earnings to be included in the S&P. So it is very high quality in general. So it would just make sense that those would do well, qual and SPY, in a year like last year. But again, as you think about 2024 and beyond, and our view is that, any recession we have would be modest. I do think it makes sense to kind of own more growth and more cyclically oriented growth as opposed to defensive growth. QQQ and SPY, and qual, let's say, those are like defensive growth, defensive quality. So I think you got to get more cyclical exposure, in the portfolio for if you subscribe to our view for 2024 and beyond.
Right. So you mentioned XLE and XLI, and XLE in particular is very top heavy. So Exxon and Chevron, they account for more than 40% of the portfolio in the market cap weighted energy sector ETF. So yes, RSPG makes a lot of sense there. Then the other theme that we have talked about a little bit already is exposure to growth equities, and you have RSPT, which is the equal weighted technology ETF by Invesco, and we also talked about QQQE, which is the equal weighted NASDAQ 100 ETF, and then you also have the GARP equity ETF SPGP. Please tell us a little bit about why you added this ETF.
Okay, so and maybe just to give like a background about our firm. So we serve as an outsourced CIO to other financial advisors, and we put together ETF model portfolios, that are core risk based, that 60-40, 80-20, let's say. We believe in two kind of fundamental things when we do portfolio construction: be diversified across factors. Some years quality factor does well. Some years small caps may do well. Once in a while, value does well. So if you own a portfolio of factors, historically, you've been able to get higher up on the efficient frontier. Then we have a liquid alts overlay, a little bit, 10-15% for the higher risk strategies. And that's to cut out the left tail, right? So if you protect the left tail, your downside exposure, you've got less to make on the way up. Okay. So when we think about factor diversification, again, our cornerstone in our portfolios tend to be quality. So whether it's qual, DGRW, ROE, that kind of shapes, our quality exposure. GARP, which is growth at a reasonable price, SPGP, it is a unique factor, right? So we're trying to identify unique sources of risk and return and to diversify our factor exposures. We want growth in the portfolio. Growth, is good. Growth at a reasonable price is even better from our standpoint. So that's the reason why we own SPGP in our strategies.
Now let's talk about the international exposure, starting with the international developed equity exposure. So you have Japan and Europe ETFs there, EWJ and DXJ for Japan. So EWJ is the unhedged Japan ETF, DXJ is the hedged Japan ETF. Then IEUR for unhedged Europe ETF and HEDJ for hedged Europe equity ETF. So looking at the performance of Japanese and European stocks last year, it was an awesome year for Japanese equities. In fact, for the Nikkei, it was the best year in a decade. And that was thanks mainly to a cheaper yen, which is good for Japanese exporters. And then Japanese companies also have very strong balance sheets now after years of Abenomics. And of course, Warren Buffett also helped Japanese stocks a little bit, I think, because he added exposure to Japanese companies. Japanese hedged ETF did even better than that. In fact, DXJ was up almost 44% last year because Japanese yen had gone down. So a hedged ETF made a lot of sense last year. European stocks also did well. It was their best year since 2021 because of optimism for rate cuts, that inflation is peaking out and the central bank there will start cutting rates. But they significantly underperformed Japanese stocks and US stocks, mainly because of concerns about China's weak recovery. And so what is the rationale behind adding both Japan and Europe exposures for 2024 and also both hedged as well as unhedged exposure?
Okay, well, you just made a lot of good, interesting points too, which, I agree with a lot of it. I would say that when we look at we run like a quant screen where we look, okay, what are the fundamentals, right? What is the P ratio? You can't just buy something because it's a low P ratio because, things like Japan have been cheap for decades and you need a catalyst for why, Japan would rally as it did last year. And the DXJ was up, considerably last year. So I think some combination of we look at P ratios, we look at growth estimates, we look at estimate revisions, and then earnings momentum. So when I look, for instance, at EZU, Europe in general, you get pretty strong estimate revisions, right? So the analysts are revising their estimates, pretty aggressively and higher than, let's say, here in the US. you've got very strong earnings momentum, and you've got cheap valuation. Okay, and you got good growth estimates. So some combination of like the P ratio is cheap, so the stocks are cheap. You've got high growth estimates, strong estimate revisions, and good earnings momentum. Like that's generally a good combination to own. The reason why we do half hedged, half unhedged is that, dollar moves are pretty typical. It's pretty difficult to time. And, because we're long term and we don't really rebalance often, it's hard to time dollar moves. So yes, I do think that Fed could lower rates. That could lead to a weaker dollar. You perhaps can get better outperformance in the non-hedge versions. So that's why we want to split it, because it's just very difficult to time these things. But Japan is fundamentally very attractive. DXJ in particular, the exporters. So if the rest of the world is not going into recession, DXJ and exporters, stocks that are generally geared towards exporting their goods and services to the rest of the world, like that makes a lot of sense to us. Whereas the EWJ is just more of like, has, the entire, country, like the MSCI Japan. So that's not going to give you as much exporter, exposure. So I think it makes a lot of sense. You don't go into recession. The rest of the world benefits. It always starts here in the U.S., and then the rally should broaden out to the rest of the world. Look, I've seen periods in my career where everyone wants to own Japan. People want to own Europe. A lot of money flows into these countries. I know it's been very U.S. centric the last 3 to 5 years, but it does make sense to own both U.S. and non-U.S. Not to be tactical. Again, a lot of advisors, they just want to own the U.S. and in particular, they just want to own growth. And we're just trying to encourage them. Okay, think abroad. These countries have catalysts for why they can go up. It's not just you buying it because it's low P ratio. There's some fundamentals in there that suggest that these companies have good earnings, good growth, good momentum on the earnings front.
All good points. So for mid-cap and small-cap equity, you added two very low cost, very popular SPDR ETFs. These are SPDR S&P 600 small cap ETF SPSM for small cap, and SPDR S&P 400 mid cap ETF SPMD for mid cap exposure. Both these charge, I think, just 3 basis points each, and both are very popular with investors. Please tell us a little bit about this exposure.
If you think about the last 10 years, it's been mostly about mega caps, mostly about US, and not only just US mega caps, but US mega caps in the communication and technology sector. And I hear all these beliefs out there and these views that, okay, the small cap effect is dead. Companies IPO directly in the large cap space. Companies like Facebook and Google, they don't go from like a small cap stock to mid cap stock to large cap stock. They just IPO and they go right into the S&P or the Russell, 1000 index. I would say that the minute I hear stories like that, I know that it's probably towards the end and that you could get into this new cycle where small cap stocks can do well. So again, like our view is that as the market broadens out, you don't get a big recession. Fed lowering rates is going to be very helpful for small cap stocks and mid cap stocks. The reason why we like those two tickers, the SPDRs, S&P small and mid cap, is that S&P has this interesting inclusion criteria where you have to have 4 quarters of net positive earnings. And so automatically that means you have like a little bit of a quality filter. So we put those ETFs, again, we're just trying to encourage advisors, like, let's think beyond just large cap, right? Let's be diversified. Let's own some of these other factors and sectors and cohorts in the market. We hadn't had, a small cap ETF in our list in many years. I've been doing this report for over a decade, as you said. So this is like a fundamental shift. Like, okay, like this is last year's 10 ETFs was very defensive. We had a lot of bonds in there. We had a large cap, but we're just trying to get our advisors to say, okay, this is a unique, actionable investment idea. There's a rationale for it, from a macro fundamental backdrop. And then it also helps from a diversification standpoint.
Right, I like both these ETFs. Now, talking about the emerging market equity ETF, you added DGRE. It is by Wisdom Tree, and talking a little bit about emerging market equities, we saw a lot of divergence last year in emerging market equities performance as well. So China greatly underperformed because of the anemic recovery and all the regulatory crackdown and other issues. Some other markets like India did pretty well last year. So please tell us why you decided to add this particular EM ETF.
Okay, so not every sector, region, country, factor should be passive. There are parts of the world, parts of the global market portfolio where you should look at active. I think emerging market makes a lot of sense. There's different risk characteristics for India compared to, let's say, like, China. We like India quite a bit because I think you get all the benefits of like the China, in terms of like, the population, the potential demand, the potential growth, but you get like a much, cleaner, easier story from like a corporate governance standpoint, from a political standpoint. So India, for instance, is like 30% of the DGRE ETF. So DGRE is active. Taiwan is the second biggest country in that ETF at 15%. So in Taiwan, we like the semiconductor exposure that you get with Taiwan semiconductors. So it checks a lot of boxes for us. I think in general, a weaker dollar this year, lower rates. As long as I've been investing for 25 years, when you have that lower rates, weaker dollar, that's been generally a good setup for emerging markets. We'll see if this year it works. I think the headwind you had, last year and perhaps part of the year before was that, you had much higher rates, much higher dollar, a stronger dollar. So you didn't have as much of a clean setup for emerging markets. So I just think emerging markets, you should be active. We rely on a lot of Wisdom Tree ETFs historically, so this made a lot of sense to us.
Now let's talk about your portfolio for 2023. So I looked at the portfolio just now. It seems that it had a lot of defensive exposure, defensive equities, dividend equities. You had a lot of exposure to commodities and fixed income as well. Now, some of those areas did not do well last year because we know that mega cap growth stocks outperformed and dominated everything. And the rally actually surprised a lot of people. So could you talk a little bit about this portfolio and what were your best performers and worst performers and what surprised you?
I would say that last year, what surprised me and what surprised everyone is that, just one small part of the market would do exceptionally well, the Magnificent Seven. And the reason why I think it made sense in retrospect is that there was so much fear of a recession. So those Magnificent Seven stocks are defensive growth sectors. And again, we're saying that this year, look to be more cyclical growth, let's say. Going into last year, I would say that the view was that let's be more defensive, right? So we had Midcap, but we had Midcap high quality. We had dividend strategies, right? So the idea is that we didn't think Fed funds would get as high as it did. So let's say we thought, okay, let's clip some coupon, let's be defensive, right? So we had, things like DVY in the portfolio, SPY-D. We had the minimum volatility ETF, right? USMV. We had the Pacer Cash Cow ETF, COW-Z. Again, more value, kind of cash flow equity. We had bonds in there. We thought that bonds made a lot of sense to have. I think that was the right call. The inflation strategies is more so because of our firm view that we thought that, inflation would be higher and stickier for longer. So I think that's the rationale. I think what I missed last year was that there would just be really so much emphasis on quality and defensive quality. So I think last year, past performance on indicative future results. Obviously, we have strategies. I would think that people should judge us on that compared to like last year's list. But If we're going to hold ourselves to it, let's hold it. So an equally weighted return of last year's list was up about 5%, and a blended benchmark was up about 10. So we underperformed. Most of the ideas produced positive returns. This started, Nina, because I was on the sell side doing, ETF research, and I wanted to kind of get idea sharing out, and I wanted to hold myself to it, and I wanted to see if the performance, was good. Did it for a long time. I was comfortable with the performance. I thought I could manage money. So then I started a story, and now we have, a 7-year live track record that's GIPS audited and verified. So I would encourage people to look at our fact sheets to see how we've done across varying cycles and what our up-down capture ratio is. But last year was a difficult year for any active manager. We're not going to hide upon that. Our ETF strategies, stock portfolios are all on our website, astoriaadvisors.com. So you can look at that to see how we did last year and years before.
All good points, John. Thank you so much for joining us today. And thank you for the excellent discussion.
Thank you, Nina.
That was John Davey of Astoria Portfolio Advisors. Now let's quickly recap some of the ETF tickers that we discussed on this episode. So we talked about equal weighted NASDAQ 100 ETF. The ticker symbol is QQQE. We also talked about equal weighted technology sector ETF. The ticker is RSPT. Now for equal weighted energy, the ETF is RSPG. And for industrials exposure, the ticker is RSPN. For Japan ETF, EWJ is the unhedged Japan ETF. DXJ is the most popular Japan hedged ETF. And as I mentioned, this ETF did very well last year. For Europe, the hedged ETF is HEDJ and the unhedged one is IEUR. For small cap and mid cap, the ticker symbols are SPSM and SPMD, very low cost and quite popular ETFs. And for international emerging markets, the actively managed ETF is DGRE by WisdomTree. Thanks for listening. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com. And if you like our show, please leave us a rating on iTunes or wherever you get your podcast.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.